we think this is actually the sweet spot for markets globally because we don't necessarily have synchronized global growth here, but we have sequential, and that's actually pretty good for markets. So we're going to hand off growth. First, China recovers. Now the U.S. has recovered. We see Europe recovering soon behind in the next quarter, which is great for European markets. And some emerging markets will lag, but ultimately they will get there. And the markets are telling you that. The Indian and the Brazil markets have been very steady, and even Brazil has reached a new high in the last week or so, despite the terrible headlines. And what that tells you is that policy has really overwhelmed the fundamentals on the ground and that markets are good. We like Europe here. We like Europe because we see the cyclical recovery, and the European markets are full of energy, financials, and other manufacturing, much higher than the U.S. market.
So, Alicia, it's funny because just about a year ago, there were some tongue-in-cheek comments coming from many parts of the market out there about the Fed not being able to produce a vaccine. The Fed is not the one that's going to cure the pandemic. Yet, whatever central banks have done around the world, it seems as though whatever policies have been made have kept markets not just stable, but upward trending the entire time. It's counterintuitive. This is something in an environment where there's a virus pandemic that could shut down parts of the economy. This is not exactly what we would expect. Have the markets now gone too far, too fast, given what we've seen in terms of economic slowdowns around the world because of the pandemic?
Look, it's a great point. A year ago, 55% of global GDP was completely shut down, and markets were rallying because of the support. It's really extraordinary. I mean, this will be studied for a very, very long time in how central banks really came to rescue a disaster here. I don't think markets have come too far at all. And as I said, we think the UK and we think the European markets look very good and poised for an inflection here. The US could soften, and the US could soften because we're mostly full of tech stocks. The S&P is 35% tech, not just those 5 large cap tech, which make up about 23%, but it's much more than that. And we do see the risk to yields higher. Now, this morning, that's not the case. The market seems pretty sanguine about whatever inflation data we're going to get. But of course, that just sets us up for another inflation scare. And so therefore, we see that those deep cyclicals will continue to work, and the reflation, right? The sectors that are going to be levered to higher inflation, because even if we don't get a really runaway inflation like the 1970s, which is also not our base case, you're still going to wind up in a higher inflationary world. And that has real implications for all asset classes and for sectors. So we still like deep cyclicals here and deep value. And we're cautious, not saying to sell your growth stocks, but just be aware they're not going to drive performance this year.
Alicia, we've got a few moments left here. So in the past, the way that you hedge against inflation is to go towards big tech and growth-oriented stocks, because that was the way that you would keep up with inflation. If there is inflation down the line, isn't that a tailwind? Shouldn't that be a tailwind for tech and media companies because of that kind of environment? Do the traditional thoughts hold?
It's a good point. This is a timing issue. And as we know, it's very, very hard to time the market. So I'd say this. I'd be careful on the more speculative names, the ones that rely on rock bottom interest rates in order to get enormous multiples on revenue. And you have to focus on the companies that are levered to the economy, somewhat cyclical in nature, and that really grow regardless, right? Cash flow regardless, margins regardless. And those are the companies you should be owning, because it is true at the end of this, too much inflation could inhibit growth. So it is timing. We never recommend to completely. You should be fully allocated, and you should have a diversified portfolio. But I'd be careful on the speculative side here. I think there's more downside there.
Shepard Smith here. Thanks for watching CNBC on YouTube.